Do you hate your job, but you can't quit because you're stuck living paycheck to paycheck? Maybe you're tired of working hard watching someone else get rich. Or worse, maybe you've been laid off. Or maybe you're approaching retirement age and you're wondering how you're going to generate income without getting another job. In this video, I'm going to show you the strategy that I've used for the last 3 years to generate income from the stock market. Not by day trading, not by chasing meme stocks. I'm talking about selling cash-secured puts. It's a strategy that allows you to potentially generate income every week while working anywhere in the world. Before we begin, I need to give you this disclaimer. This is not investment advice. I'm not a financial planner and I don't know what your personal situation is. These strategies and ideas discussed in this video are for educational purposes only. But now let me answer a question that I know that you have. Why on earth should you listen to me? First is my experience in the market. I've been involved in the stock market for over 30 years. I've been through the booms and the busts. I've witnessed markets both as a trader and as an investor. I've spent thousands and thousands of dollars on training, including courses, webinars, seminars, chat rooms, coaches, weekend getaways with professional traders, and now I make a full-time living as a trader and an investor. I know what works and I know what doesn't work. Second is my reason why I'm doing this. I've been laid off 7 times. Yes, that's right, 7. I've been told your position has been eliminated, or the company has sold, or that new management is coming in, or the company lost a major account and they can't afford to keep you any longer. You see, the reason didn't matter. I found out the hard way that I was expendable. I learned that a company will never care about your financial future as much as you do. So instead of looking for another job, I started searching for ways to create income that didn't depend on a boss or a company or a paycheck. And for me, that was the stock market. About 10 years ago, I started taking my trading more seriously and I learned how to sell puts. Then 3 years ago, when I lost my job in corporate America, I decided it was time to work for myself. And now I sell put options full time. This isn't a theory. This isn't something I read in a book. This is how I earn my living. And if you're willing to learn, it could become an additional source of income for you too. Let's use a real example so that I could show you how it works. I like a company called Applied Digital. Applied Digital is involved in data centers and artificial intelligence, so it's a very popular stock right now. The ticker symbol is APLD. On the left is a daily chart of Applied Digital, and on the right is a 1-minute chart of Applied Digital. I use the daily chart to look for the overall picture of how the stock has performed over the past year, and I use the 1-minute chart to see what the stock is doing today. Now, I've been following this particular stock for several years, and I'm comfortable owning it. But let's say I don't want to buy the stock at the price that it's at right now. The stock price is $41.47, but I'd like to buy the stock at $38. So I have 2 choices. Choice number 1 is I can wait for the stock to go down to $38 and buy it, but the stock might not go down. Maybe it's such a good buy right now that other investors are buying it too. And when there's demand for a stock, the stock goes up. So instead, I'll use choice number 2. I'm going to sell the $38 put option. So let's look at the options page. I'm using the Thinkorswim platform. And to get to the options page, I'll click on the trade tab right up here. Take a look at the left-hand corner right here. That is the option contract expiration date. Remember earlier I said that when you sell a put option, you are agreeing to buy 100 shares of stock at a price that you like on or before a certain date. That date is called the expiration date. Next, look at the column right over here called strike. Strike basically means the price of the stock. Remember earlier I said that I'd like to buy the stock around $38? Well, right here under strike is where I'm going to find that I'd like to buy the stock at. Let's compare the $38 strike price for the June 12th expiration week, and you'll see it's this price right here, 10. Let's compare that to the $38 strike price in the June 18th expiration date. The $38 price for the June 18th is 70. What did you notice? The premium in the June 12th expiration date is substantially less than the premium in the June 18th expiration date. Well, why is that? Because the premium of a stock market option is based on 3 things. Number 1 is the price of the underlying stock. As the stock goes up and down throughout the day, the premium of the option also goes up and down. Number 2 is volatility. Some stocks have bigger and more volatile price swings. If the price of the stock is up and down all over the place, the volatility is going to be higher than the stock that barely moves. And number 3 is time. The more time that is left in the option expiration date, the more value you get in the premium. So in this example, today is June the 11th. There's only 1 day left until the June 12th expiration date. So the premium is going to be low. In this case, it's only 10. But if you're willing to tie up your money for another week, in this case, June 18th, the premium is going to be substantially higher. In this case, it's 70. More time, more money. Instead of buying 100 shares of Applied Digital and hoping it goes up, you can sell the June 18th $38 put option contract and collect $70 right now. Notice that there's a decimal in front of the premium price. That's because the premium price is being displayed as price per share premium. But remember that option contracts control 100 shares of stock. You have to multiply the premium by 100. Let me show you another reason why selling put options is such a great strategy. How much money are you currently earning on your cash sitting in your brokerage account? Or worse, how much in your bank account? Now, I actually do get 4.9% a year in one of my brokerage accounts. In a nutshell, that means that my money is collecting interest. And while that's not necessarily a bad thing, wouldn't you rather make a lot more interest on your money if you knew how? Let's go back to our June 18th example that we used earlier. We sold the Applied Digital June 18th $38 put option contract for $70. Now, how much money did we have to use to do that trade? Remember that when you sell one put option, you are agreeing to buy 100 shares of stock. 100 shares of Applied Digital at $38 equals $3,800. Thus, you need to have $3,800 in your brokerage account to place this trade. So in this example, we took in $70 in premium, but we needed $3,800 to place the trade. To calculate the percent return, you take the money collected, which is $70, and divide that by the money needed to place the trade, which is $3,800. 70 divided by 3,800 equals 1.8%. Now, at first, 1.8% might not sound like that much, but how long did you have to wait to get it? You only have to wait 1 week. June 18th is next week. Now, here's where it gets really interesting. How many trading weeks are there in 1 year? There are 52 weeks in a year, but with holidays and other things that come up, and for easy math, I calculate 50 trading weeks in a year. So if you get 1.8 return in a week, and you can do that every week, and I can tell you from experience that 1.8% every week is not only possible, but I actually do it. What percent return is 1.8% a week in 1 year? Well, let's do the math. 1.8 times 50 weeks is 90. That means you can earn 90% in a year. Now let that sink in. So would you rather earn 4.9% a year by letting your money sit idle in a brokerage account? Or would you rather make 90%? And now let's talk about the freedom that you'll have. You could trade from your home office, a hotel room, the airport, on a cruise ship. You could trade from any country or any place in the world. All you need is an internet connection. There are no employees, no customers, no inventory, no payroll, no staff meetings, and no sitting in traffic commuting to work. On most days around 8:30 a.m., I'll study charts, look at the market news, and get a feel for what's going on. Once the stock market opens at 9:30 a.m., I typically place a few trades, and I'm normally finished for the day around 10:30 a.m. That means I have the rest of the day to do whatever I want. And as I stated earlier, this process can be done anywhere in the world as long as there's an internet connection. Now let's talk about how much money you'll need to get started. You will need some capital to sell puts to generate any meaningful income, so you can't start with $50, but you also don't need $1 million. Many traders begin with smaller accounts and gradually build them up over time. And here are some additional tips that I learned over the years. I never put more than 10% of my total portfolio into any one trade. Thus, if you have a small account, you will need to trade stocks with lower strike prices. Using our example from earlier, where we sold the $38 put option, we would need $3,800 in our brokerage account to place that trade. But if we follow the 10% rule, where we don't put more than 10% of our total portfolio into any one trade, the ideal scenario would be to have at least $38,000 in our portfolio. The goal is consistency, not excitement. The market rewards discipline, not gambling. Another secret of smaller accounts is to go for smaller, consistent wins. Don't swing for the fence every time trying to hit home runs. Selling puts allows you to make a living and retire comfortably without having to have millions of dollars in your brokerage account. It does take some searching and experience, but getting up to 2% a week return selling puts is very common, and I do it every week. Let me show you some examples. Here is my trading log. I keep track of every trade. I put the date of my trades here, the time of my trade. The letters STO means sell to open because I opened up a new trade. This is the number of contracts that I sold. Next is the option expiration date, and there are a few dates that are longer than a week because some of the less popular stocks only have monthly options. The next column is the ticker symbol of the stock option that I traded. Next is the strike price, and next is the type of option. Now, most of these are puts, but you will see a few calls on here. I'm going to go over what covered calls are in another video. Next column is the premium that I collected, and this column is the price of the stock when I placed the trade. The next column is my true cost. This is calculated by taking the strike price of the stock that I sold the put option and subtracting the premium. The next column is my profit. I wait until after the expiration date to calculate profit. Next is which brokerage account that I use. This is optional if you want to put that or not. And our last two columns are the percent return that I get from each trade. Now notice the returns here. The lowest is 1.29% and the highest is 4.8%. So as I said earlier, it's very possible to get between 1 and 2% return a week. And you'll also notice color coding on the spreadsheet. White means that the trade is still open, yellow means that the trade is closed, and pink means that I sold covered calls on the stocks that I own. Another tip is that I never use margin. Let me repeat that. I never use margin. Margin increases risk dramatically, and it can destroy an account during volatile markets. Cash secured puts are called cash secured puts for a reason. Always maintain the cash necessary to purchase the shares if you are assigned. Now, occasionally the market swings down and you'll have to buy the shares of stock. But there are other strategies on what to do if you are assigned the shares of stock. You can sell them when the market goes back up, or you can write covered calls. I will go into detail about what covered calls are in another video. I believe that selling puts is one of the most powerful income strategies available to investors. Feel free to leave a comment. I read each one myself. Thank you for watching, and we'll see you in the next video.